The fire at Cusco that raised down 13.2 billion and left the institution insolvent was put out by the Ministry of Cooperatives by dissolving the board and instituting an interim board, which among other functions is supposed to manage and take care of the Central Finance Fund. The Central Finance Fund is the pool into which member SACCOs contributed their deposits into. And therefore, this new outfit, which will be under SASRA regulation, is supposed to manage that fund with an aim of restoring SACCOs for what they may have lost and provided for in their books. At the same time, the former MD George Ototo with his accomplices have found themselves in court in a case where allegedly it said they sold an inexistent land to Cusco Housing for value of 82 million, and that cash was withdrew from the bank account and handed over to an advocate who distributed the money among the accused. At the same time, Cusco housing defaulters are bidding goodbye to their homes through an auction that is meant to recover the unpaid amount to bridge the gaps left in the institution balance sheet through the brazen haste. And on our side, as members of cooperative societies, our emotions have been whipped seriously by online money market fund experts who have alleged that SACCOs are collapsing and that we should rush and withdraw our membership and our investments from the SACCOs. That is a matter that we wish to settle through this video because we greatly disagree with such findings and wish to put forth 5 important things about SACCOs that must be noted by every happy good member of a cooperative society, because it is these 5 things that distinguish what happened to Cusco with our SACCOs at the moment. For that reason, because SACCOs is a subject that is hated and loved in equal measure. And for that reason, we invite your opinions to shape the discussion in the comment sections. At the same time, don't forget to like this video, and because it has value, share it to another person. See you after 3 seconds, a short break. Welcome back to the 5 important things that distinguish our regulated SACCOs from the calamities that are facing Cusco. Number 1, we will look at regulation by SASRA and what it brings to the SACCO. The purpose for looking at this regulation is that Cusco was not regulated. Cusco was not under SASRA. And therefore, there are terrible things that happened under Cusco that led to immense pressure on its finances, and they form part of the liquidity problems and the insolvency status at Cusco. All SACCOs are regulated by the Ministry of Cooperatives through the Cooperative Act, in which all SACCOs get registered and incorporated. SACCOs are cooperatives by that registration of the Cooperative Societies Act, but by their business model, these are financial institutions. And for that reason, deposit-taking SACCOs are further regulated by SASRA through the Sacco Societies Act, under which SASRA issues the operating license to carry out the banking-like business activities that are called FOSA. The regulation by SASRA for deposit-taking SACCOs require that these SACCO file 2 mandatory reports on a monthly basis. These reports are supposed to check on the performance of the largest asset of every SACCO and its accounting and provisioning. The first report is a delinquency management report or loan provisioning report. This is a report that outlines the aging of the different classes of loans under the SACCO. Delinquency means default, and a loan is considered to be in default or delinquent if it exceeds 1 day without being paid for. And therefore, a delinquency management report or provisioning report classifies the loan book, the SACCO loan book, into ages of the loans, where we have 5 classes or clusters of those loans by aging. We have the first cluster of 0 to 30 days of aging. We have 31 to 90 days of aging. Then we have 91 to 180 days of aging. The fourth one is 181 to 360 days of aging. Then the last cluster above 360 days aging. Each of the 5 classes require a specified amount to be set aside from the profits of the SACCO to cater for the non-performing loans in each cluster. Because the law and the regulation that govern delinquency management require that all SACCOs maintain their NPLs, non-performing loans, at a maximum of 5% of the total loan book. Take your time as a member of a SACCO, go through the balance sheet of your SACCO and discover that the largest asset of your SACCO is the SACCO loan book or the SACCO loans. And that is why that asset requires such humongous supervision by the SASRA body. In our clusters, any loan that exceeds 360 days of default, that is the 5th cluster, is required to be treated as a loss. That money is lost or an irrecoverable amount, and therefore the entire amount in that cluster should be provided for in full. The second cluster, which is any loan that is between 181 days to 360 days, any loan above 6 months in default is supposed to be provided for up to 75%. The assumption that 25% may be recovered or recoverable. Then the third cluster, which is 91 days to 180 days, is supposed to be provided for at 50%. Then we have the second cluster going for 25%, and the first cluster of 0 to 30 days is not provided for. There are systemic assumptions of things that could happen to cause such delays, including a delay through a check-off system where the HR department has not recovered that amount in those days. So there is assumption of delay, and that is why those loans are still considered fully recoverable. Then the second report is an insider lending report. SACCOs as lending institutions have 2 classes of customers. They have the external customer, who is the member who is not working in the SACCO. Then we have the internal customer, and these are the SACCO staffs. All SACCOs, the directors, and all the SACCO staffs must be members of that SACCO. So the loans that are provided to the SACCO members of staff, that is what constitute insider lending. Insider loans can heavily be influenced in the absence of proper loaning policy. That's why SASRA, through its regulation, caps the maximum that can be lent internally to members of staff to a 2% of the loan book. So that report is very important, and the regulation to curb abuse of office by the members of staff. So looking at those 2 reports, where the delinquency management report is supposed to cater for provisioning of those loans and curb insider lending, you will realize that those are the major things that were missing under KUSCCO. In which case, the MD is allegedly having over 100 million worth of loans against deposits that are less than 500,000, and those loans were not provided for as non-performing. The loans didn't have any collateral or guarantee. A teller at Cusco with only 17,000 found himself servicing a loan of 3.3 million. These two reports do not handle the internal loaning mechanism or procedures within the Sacco. The two reports are supposed to curb insider lending and ensure proper provisioning of non-performing loans. That brings the other aspect that Cusco suffered, that is overstating their performance. Where Cusco financial statements implied that Cusco was performing and gave a healthy record in their financial books, if Cusco provided for non-performing loans, it is required under the accounting standards, then Cusco performance would not have been what it has. And that lack of provisioning for non-performing loans is what was used to cover up the embezzlement of Cusco monies through expenditures. That was realized through the forensic audits by PricewaterhouseCoopers. Very important to note at that point, SASRA is not into the Sacco loaning procedure. SASRA does not look into whether the loans manager and the appraisal teams used the proper procedures in awarding these loans. SASRA, through these reports, is looking at the capping of insider lending and provisioning for non-performing loans that can also be occasioned by dishonesty and integrity issues within the Sacco systems. That is 100% of what Cusco suffered because of lack of regulation. Number two, we are looking at member contributions of deposits and the Sacco loans. And the purpose of this part is to indicate the security of member monies. And as per the Cooperative Act and the SACCOS Regulations Act, the total members' deposits must be held in member loans. So there is no way a Sacco deposited member contributions to Cusco. The question that rings in your mind is then what were these monies that these SACCOs were contributing towards Cusco? Were they not member monies? I will show you where that money comes from. Member deposits are held in member loans. Verify that statement as a Sacco member by again taking a look at your balance sheet, Sacco balance sheet. Look at the total loans and go down to liabilities and check for members' deposits. Member loans will be under assets. Then the deposits will be under liabilities. You will notice that all the member deposits are within the loans, or rather, the loans are either equal or more than the members' deposits. In the case where the loans are more than members' deposits, that difference is bridged by using the members' share capital to award loans. So SACCOs are always, in terms of safety of members' money, the member contributions of deposits are held in member loans. The third item is provisioning for reserves. The law requires that every SACCO yearly out of its profits, which we also call surplus in this case, they are supposed to set aside 20% of that yearly surplus or profit to a reserve, a capital reserve. Every year that the SACCO has made a profit, every year that the SACCO is paying a dividend, because you can't pay dividends where there are no profits, except in a circumstance that I will tell you. The SACCO must first, before considering the dividend and interest to members, must take 20% of the total surplus to a reserve. The SACCO will also set aside another part of the surplus as retained earnings. Just like under personal finance, we tell you as an individual, always make sure you set aside something to your savings for investments. That also happens to institutions or business bodies. A part of their surplus, a part of the profit is retained for future expansion purposes or for future smoothing of the dividend curve. Then there is the part that now will be used to pay out interest and member dividends. There is importance to that provisioning. And if you remember, number one item that we talked about, the regulation for delinquency management, non-performing loans are supposed to be adjusted, provided for, and adjusted from the loan book. That automatically adjusts the surplus as a management expenditure or item. So this amount of 20% that is set aside from the surplus before we distribute interest and dividend to members, that 20% reserve is not attributable to any person. So even if the members were to dissolve the SACCO and share, what you are entitled as a member, you first get your deposits, which are free from your loans. But there are amounts in the capital structure that do not attribute to any member. And because SACCOs are assumed to be perpetual bodies with open membership, members are coming in and those who with the willingly withdrawing are leaving the SACCO. But what you ask for when you are leaving your SACCO is your net deposits. That is your deposits minus any liability from relating to the SACCO from you. And those are loans and any other amounts that maybe you are supposed to pay for the SACCO. You cannot withdraw the share capital from the SACCO, but it's attributable to you. You are allowed to transfer that share capital to another member through a private arrangement, which will be now administratively managed by the SACCO. And that is heavily misunderstood by many people. If you buy shares of a company, let's say an example of Safaricom, you cannot walk into Safaricom offices and demand to be paid your share capital back. Anything called share capital relating to companies, because SACCOs are companies. And that's why the name of your SACCO, ABC Limited or whichever name, it ends with a suffix of LTD Limited. That denotes that this is a company. The share capital of a company is a permanent capital to the company, and therefore if you purchase shares, whether it's a SACCO or is any other form of company, you cannot demand that money from the SACCO, but you are allowed to transfer your share capital to another person, a member, by selling. You sell your shares to a willing buyer. Then that transaction will be administratively registered in the books of the society or the company registry where that exchange is done. The same, so for SACCOs, while the share capital is attributable to you, you are supposed to sell it to another person, but you cannot withdraw it from the SACCO. But there are these amounts that we have stated. The 20% that is set aside from the surplus or profit of the SACCO every year that a dividend is to be paid out. There is an account called a capital reserve which receives 20% of that year profits every year. And that amount belongs to the SACCO, not attributable to any member. Then we have the other item of retained earnings, retained profits, retained surpluses. The same, you as an individual, you don't consume everything that you earn. You set aside some amounts for your investments to expand your wealth in assets. The same happens with companies, SACCOs being a form of a company. A part of the profit surplus will be set aside as retained earnings. The distinction between what we have, the 20% we have called a capital reserve and a retained earning is that capital reserves cannot be future distributed to the members in future. But the retained profits, the retained earnings, in future years where the SACCO is struggling and didn't make enough amount to pay out dividends and interest, they can access the retained earnings and distribute to the members as interest or as dividends. The same happens to companies because shareholders need to be paid something to keep them confident with the institution. The expectation by any investor is that they will continue receiving dividends in future years. So, as directors of a company, when in the event in a particular financial period things don't play out very well, and the director or the board observe to maintain a certain curve in their dividend payouts, they can access part of the retained earnings to supplement what they have made and pay out as dividends or interest in case of a SACCO. And that is now where we bring in the issue with what these SACCOs had invested in Cusco. The losses, any loss that happen, or any anticipated contingent liability, just like a case where maybe a SACCO has been taken to court, as a company has been taken to court, and you foresee out of the process, it comes to a stage where you are advised that this case, you are going to lose it, and you'll be slapped with this kind of a bill or charges. You now, when you are sure of the specific amounts that can possibly be the charge or liability to the institution, that amount you provide for it, you create as an expense in the income statement, or you reduce your profits before distribution by such amounts. That is provisioning. And exactly that is what should happen with whatever SACCOs had put in Cusco, which is deemed to have been lost because of such embezzlement. Though we have said that in the new directive from Ministry of Cooperatives is that the new board is supposed to take care and manage the Central Finance Fund, which is supposed to restore the SACCOs. But that has to be provided in the books. But these amounts are not deducted at once because the investment could be material enough that if you want, in accounting, we say a figure is material or is consequential if I deduct the whole amount from the income statement, that is profit and loss account for better understanding, it can change a profit to a loss. Or if it's a sort of income, if I bring it to the income statement as a whole, it can change a reported loss to a profit. For purposes of fair view of the income of the reports, this amount, the SACCO will be allowed to be deducting small amounts over a period of time. The board can choose 5 years, 10 years. I've seen from some SACCOs income statements, some SACCOs provided for the entire amount because the total amount of 24 billion which had been contributed towards Cusco over 287 SACCOs, if you get an average of what each SACCO had put under Cusco, it's not much. So provided over 5, 7, 8, 10 years, the amounts that will be provided for or deducted to take care of such losses is so immaterial, inconsequential to affect the dividend payouts by these SACCOs. So in most cases, members will not even notice whether these figures are being discussed. But for purposes of disclosure, these are figures that must be shared through the AGMs. But unfortunately, not all individual members attend AGMs for these SACCOs because most of them are managed through a delegate system. So in that number 3, we have handled 2 things. We have handled the legal 20% provision for a capital reserve. We have also handled the provisioning for retained earnings. These are figures that are very important to every investor. Whether you have invested in a company through purchase of shares or you have invested in a SACCO, These are some of the information or figures that you need to keep on checking through the balance sheet, the financial position statement, or the income statements. So the last item that we need to look at is the internal control system, the internal control measures of the Sacco, because part of what bedeviled Cusco is a blatant failure to follow their internal policies. There is this person called the external auditor. The external auditor, in pursuant to their work, they are required to plan their work in such a way that in the process of conducting their audit, independent audit, their procedures will be sufficient to discover or unearth errors and frauds. The reason why PricewaterhouseCoopers forensic audit did unearth all these things about Cusco. So your Sacco as a member, there is a party procured as an external auditor and appointed and approved on every AGM. That is the person who is mandated to ensure that they conduct audit procedures and sufficient enough to unearth frauds and errors in the Sacco. But the responsibility for instituting reliable internal control systems and procedures lies squarely with the management. So in this case where Cusco, we are getting an individual accessing a loan in close to 200 times the amount of their deposits, when we know that the highest frequency in the Sacco movement is 5 times your deposits. A teller with only 17,000 accessing a loan in excess of 3 million, those are failures to rely on the internal control measures, internal policies by Cusco itself. And that cannot be cured by any external party. That cannot be cured through regulation. It's blatant abuse. SACCOS, the procedures are that there is a segregation in performance of duties to ensure that loans are not defrauding the Sacco. Members will not collude with staffs to access loans without satisfying the requirements. Although that is a part that can be misused. But that is the reason why we have the delinquency management measures. If there's an institution, they allow such to happen through SASRA regulation and provision of those reports. At some point, SASRA will invoke articles in their regulation, and in some cases, SACCOs have seen their licenses cancelled. And a good example is the Sukari Sacco. Sukari Sacco, a member of Cusco, which also had borrowed heavily from Cusco to a tune of around 40 million, had their license revoked by SASRA. And that revocation of that license also caused the default under Cusco. But you see, Cusco being unregulated had a lot of change because part of what they would have relied on would have been a regulation report under SASRA. But that notwithstanding, those are 5 important things that distinguish our SACCOs from what is bedeviling Cusco. And with that, then, it is clear that with this specific matter happening at Cusco, we are safe in our SACCOs. And in our next video, we'll be looking at where to put our money next. Is it in the share capital or in the deposits? Thank you for watching and see you in our next video.